this, the first. Welcome back. Let's take a look at futures on this, the first trading day of the new month, December, final month of the year. Dow Industrials right now up 45, Nasdaq down 11. The S&P is higher by 1.5. Yes, it's a fractional move today, but the stock market has had an incredible November. Best month of the year. The S&P 500 seeing its second best November since 1980. Yesterday, the Chicago Purchasing Managers Index came in at 55.8. Moving back into expansion territory after 14 months of contraction. That was certainly a positive. Joining me right now is Bolvin Wealth Management Group President Gina Bolvin. Gina, great to see you. Thanks very much for being here. You think this rally continues going into year end?
You know, I think it could. The average return in the month of December, Maria, is about 1.7%. Usually it comes in the latter half of December. There's a couple of reasons why we think it could extend. And one of them is window dressing, where portfolio managers have to show what they own, and they're going to want to show that they own the winners of the year, which is technology. And so I think it could extend, but not many people invest just for 30 days. We're really looking for 2024, and we think this market rally can extend into next year.
Yeah, I mean, I know that yields came way down in November, and that's what really prompted this stock market rally for the month. I mean, yesterday, last day of the month, Dow Industrials up 500, but, you know, we went from 3.7% or so on the 10-year to all the way up to 5% in October, and then back down again. Now we're sitting at 4.33% on the 10-year, and that's one of the reasons that we've seen such a great November. But let's not forget the macro story. I mean, the macro story is slowing. Even JP Morgan CEO Jamie Dimon, and I will say that he's been warning about this for a while, but he warned again this week of a looming recession, saying a lot of things out there are dangerous and inflationary. Be prepared. Interest rates may go up, and that may lead to recession. Jay Powell is set to speak in a fireside chat on the economy this morning. Gina, how closely are you watching the macro story, and is that dictating how you allocate capital right now, given these expectations of slowdown and perhaps recession?
Well, obviously the consumer is slowing, and I think the question is, what took so long? Look at everything that we've been through this year. The Fed wants to see the consumer slow. But when you take a look at Ultra Beauty last night, they had great earnings. Salesforce had great earnings. It's really earnings that are going to drive the market. And we've had a pretty good, better than expected earnings season. In fact, revisions have been increased for 2024. I think that's going to drive, I think that's really going to drive the market. You know, regarding the macro story, we saw Fed speak this week where even hawks like Loretta Mester and Christopher Waller came out and said inflation is coming down. What really started this rally for November, Maria, is the CPI print that came out on November 14th. And we saw some information and data from the PCE yesterday that inflation is falling. So I'm looking to see what Powell is going to say today. I don't think he's going to say anything new. I think he's going to be a cut and paste of what he said, that we're going to be data dependent. But inflation's coming down, and let's see if Jay Powell is as stubborn as is more stubborn than inflation. Well, and I think that's the risk to the market.
I mean, Rebecca, jump in here, because one of the reasons that this market has been so strong is this expectation that rates are going to go down. I mean, if rates go down and the Fed is forced to cut, isn't that in response to exactly what Jamie Dimon is talking about, a potential recession?
That's exactly it, Maria. It's the whole story that we've had. Bad news is good news. So the market is anticipating that things are slowing down. And even though CPI is coming down, it kind of reminds me of the beginning of Japan and their 10-year stagflation, deflation. You know, we pushed so hard to get people to stop spending and stop having money and stop having savings that now their savings have dwindled. They're almost maxed out on their credit cards. We're almost at maximum, like over $1 trillion. We're seeing consumer defaults on high interest rate credit cards, car loans going up, Maria. So we're starting to see that this is going too far to the wrong direction. That's bad news. And so now we're pricing CME Watch in on a March rate cut. And we're starting to expect that. And the market can get ahead of itself again if we're starting to expect a March salvation, and really we're really going now into a deflationary, recessionary, stagflation type of situation. So the macro really is, Maria, there's so much more going on at the global level that we don't even talk about because we're really talking about the Fed policy and the United States. There's so much going on at the global level that is going to have an impact in the next 3 to 4 months that it's terrifying to me. So I agree with Jamie, for sure.
Yeah, you're agreeing with Jamie. So Gina, I mean, your thoughts at this point with the reality of a slowing economy, is that causing you to shift money out of stocks?
No, it's not. I think one point, certainly that's a risk, right? The risk is that inflation stays high and the market's anticipating a cut. The market is anticipating a 68% chance that the Fed is going to cut rates. The risk is that they don't cut and they stay higher for longer. I don't think they're going to increase rates in an election year. And I think that's a good point, especially when you take a look at the election. And if it's between Biden and Trump, Jay Powell is not going to want to be responsible to put Trump back in the White House and put this economy into a recession.
Right. All right. Well, just to be clear, there was a 4% growth quarter there under the Trump administration. So the economy was a lot better at that time. But Gina, we're going to follow all of that. And we appreciate your time this morning. Thank you.
Thanks for having me.